good afternoon, and welcome to Options Brew TV. I'm your host, Lex, and today we've got another great guest, Mr. Rance Mashek. I probably said that wrong.
Nope, you said exactly correct.
I said it right?
Yes.
So Rance, I'm going to let you tell the story, but you're with IvestPlus, and I know there's some other names here, Market Gear. I'm going to let you do the tale here because you've had quite a storied life in the industry. I know you've been around for a while like I have. You go ahead and tell us your story, and then we're going to get into some cool stuff that you have to show us, man.
All right. So I was in the education space back in the 90s, teaching people about investing in stock and in options. And then ended up building some software in early 2000, and in 2000, continuing to run in that game and all. And then in 2007, that company was actually acquired by TD Ameritrade. And I became, in a very short period of time, director of options trading at TD. And I actually was involved in rewriting their margin engine. TD Ameritrade was one of the first big boy firms to be able to do a lot of different multi-leg option trades, a lot of different spread trades. And, a lot of the firms would basically do basic verticals, but not complex things or ratios, all that. We were involved in rewriting the margin engine there so that they could do that. And then that also opened the door for Thinkorswim acquisition. And I was involved in that. In fact, I was driving the integration of that. And one of the things that I found the whole time I was in Ameritrade was some of the tools, some of the things that I felt was really helpful for people weren't really there. And so we ended up building out IvestPlus, which is primarily a B2B company, but we also have, and we're going to be talking about this today, marketgear.com, which is our retail platform that really helps people be able to understand things quicker, easier, has great journaling, has a lot of really phenomenal tools in it. And so we started doing that, and we've gotten a lot of traction in the place with that. Now, my goal here today is to actually teach a strategy that if you've had a stock that went down, how you can get back to break even quicker. But you're going to see a little bit of the platform in use when we do that as I go through the strategy today. So you'll see a little bit of the game plan on that. But been in the industry for quite a while, and I just one of the things I really feel so strongly about is options give you so much more flexibility to trade in literally about any market condition. And right now we're seeing more volatility, and that gives us some even better opportunities with options. And I just have felt really strong about this my whole career in this, and I look forward to sharing one of the strategies that is a great way for people that aren't real familiar with options to be able to step into this and maybe fix a situation that's not great for them right now on a stock. So that's
awesome. Well, that's a heck of a background. So you were there in the early days of TD, you mentioned, and when Sosnoff created this Thinkorswim thing, you were around at TD around that time.
Yeah. So I joined TD in 2007, and we acquired I think it was 2000. Was it 9 or something like that? They acquired Thinkorswim, and one of the challenges I saw with Thinkorswim is it's like if somebody that's learning how to trade options and you put them in front of a jet cockpit while they're still learning to drive a car, right? It's a great platform, right? But it's just so much to it that the average person's not going to use, and not so. We wanted to build something that was simpler, that would really help people get there and still be feature robust. And you'll see that. And one of the things I love being able to, we connect to multiple firms, Tradegear being one of our great partners, great pricing. And I got to tell you something, that great execution, which is today is even more important. We went to zero commissions, but the problem is they still have to get paid, right? So how do they do that? Sell an order flow or whatever, but fill rates are so important, and I really like that about what you guys do, and like connecting to you guys. So it's been a great relationship with Tradegear.
Well, great, yeah, and you've been a great partner as well. We just love the interaction. That's terrific. So you're going to take us through a particular strategy. You want to talk a little bit about the platform or show it? Should we go there now?
Well, I think what we could do if we go to this, I'm going to jump into the strategy because you're going to see some of the platform through the use and then at the end we'll talk a little bit about the platform if we can.
Perfect.
So I think it's a great way to approach it.
So do you want me to share your screen?
Yeah, it'd be perfect. Right.
Okay. There we are.
There we go. So what we're going to do today is talk about a stock repair strategy. And in a stock repair strategy, the idea is, you bought the stock and the stock went down. what are your options? Pun intended, right? What can you do with that stock to be able to make your money back quicker? And that, so that's what we're going to teach today. And unfortunately, I have a couple of stocks here that I did a really good job at picking the top, right, and bought the stock. And I think we've all had those moments in time when we've been in the market for quite a while, and then we get humbled by some of the moves that take place.
Sure.
So I want to share some things that we can do with that. And so one of the things I do want to say just real quick, what we're going to talk about today, we're going to use some real numbers, some real things. I just, obviously nothing I do today should be considered a recommendation or endorsement for a specific position, but we want to be able to get into this and show you some things with some real numbers. So we're going to be doing that today.
Yeah. So Rance, let me interrupt. This is my favorite topic, the disclaimer. Okay. Going back to the disclaimer, I always have to let people know, and it's at the end of our show, the disclaimer. So Rance and I aren't on the broker dealer side, so we're not advisors. We're just kind of showing you some stuff, right?
That's correct. Exactly.
Yes.
Right.
That darn disclaimer thing. Anyhow, go ahead. Sorry.
Yep. All right. So let me tell you the basics of this, and then I'm going to go over to the platform and show you this in practical application.
Perfect.
So what this is, where do we go? There we go. So what we're going to do is basically we currently own the stock. We bought it at a higher price. It's dropped down. And, from this point, we feel like it's, got some good baseline here, and then it has a chance to go up from this. So you have to be bullish from your current pullback, but for the strategy to really work. But what we're going to do basically is just sell a covered call on that stock. But we're going to take the money that we took in from the covered call and use that money to buy a bull call spread on this position as well. So the fact that you're using the money from the covered call to buy a bull call spread, when you enter this trade, it should be for even or maybe even a little bit of a credit. So the thing about this stock repair strategy, it's really cool, is it doesn't cost you anything to do.
Okay.
And by the way, I'll make the claim up front, you can get back to break even in half the move.
Nice.
Right. So
far, I love it.
All right. So that's what we're going to talk about.
Okay. Can I ask a question? If you say to me that we're going to cover that in another slide, Lex, then I'll be quiet. But let's talk about first thing, covered call. Can we just describe that for some of the beginner users, or are you going to talk about that in a second?
No, actually, I'll tell you what, that's a great thing to do.
And we'll hit the bull spread too. And
yep. Right. So a covered call is I own the stock and I sell somebody else the right to buy the stock from me at a certain price. Right.
Okay.
So by doing that, I take in a premium, right? I sell a call option. And when I sell a call option, I'm going to get some money for that. And that money is mine, whether they buy the stock or not, whether the stock goes, down, whatever, that money I took in is my money.
Sure.
And then if the stock goes up and they want to buy it, I've sold them a contract that gives them the right to buy it from me at a set price. So that's what a covered call is. They can buy that, you take in money for giving somebody the right to buy the stock away from you or take the stock away from you at a specific price. Okay. And then a bull call spread is basically we're going to buy a call option. And now that we own a call option, let's say I buy the $100 call option, I'm going to go sell like the 110 call option.
Okay.
So what does that do? What that does is I'm going to buy the call option, which gives me the right to buy the stock at 100. I sell somebody else the right to buy the stock away from me at 110. The combination of what I spent for the one I buy and the money I take in for the one I sold will be less than the spread, right? So if I do the 100, 110, I'd be trying to get into this for like, let's say $4, right? So $3.50, $4. If the stock goes above 110, what's going to happen? I'm going to buy the stock for 100. Somebody else is going to buy the stock away from me for 110. That's $10. I paid $4 to get in the trade. I just made $6. On that $10 move, I could make 150% return because I put $4 in and got $6 out. Right. So that's what a bull call spread is. You're buying a lower strike, gives you the right to lower strike call, gives you the right to buy the stock at that price. Then if it goes up, you're selling somebody else the right to buy the stock away from you at a higher price, and you get to make. They call it a spread. You get to make the spread. Right. Minus the cost of trade. And so as I define that, you're going to see those two things in action in just a second in the platform.
Let me just ask another question. We'll go back to the screen share in a sec.
Mm-hmm.
So what's important to note too is that you were describing that bull call spread. So for the folks, that's a debit. That's going to cost us something. And I think in your example, you used $4.
$4, correct.
In the previous bullet point, and we'll go back in a sec, you're selling a covered call. That's a credit. And that credit, I think you're going to get to the third bullet point, is hopefully going to cover that debit spread. So we got this sucker on for even and maybe a credit, who knows? And you're going to talk about that in a second. But I want the folks to know that there's some debits and credits going on here at the beginning of the strategy, which is really cool.
Right. And so the idea is the covered call credit. You got it exactly what you said. The covered call credit that I took in is going to cover, in essence, in this example, I said $4, right? It's going to cover the cost of that bull call spread. And what that does is it basically means that the bull call spread is on for free, right?
Yeah, exactly.
And then if the stock goes up to the point I sold, I get to make money on the stock. And if the stock goes up, the bull call spread's also going to make money. So I'm making money two ways in this trade, which is why you're able to get back to break even sooner.
Love it. Love it. Now, let me ask you another question. Sorry to keep interrupting, but this is so interesting. Do you ever do this stock repair and you take out the word repair and you just do the stock strategy, meaning you haven't necessarily had your stock go down, but you do the whole covered call part of this, you do the bull spread part of this, and you do it just because it's a really cool spread, I think.
But it is, right? And when we see this, I'm going to show you the risk profile, and you'll see that it is a pretty cool position. What I would say is, usually when I present, when I talk about this, toward the end, I talk about, do I have to wait till it's broke to fix it?
Got it.
Right? And the answer is no, you don't. You can do it as an entry strategy all the way. In fact, there's some rules as a repair that you have to follow that you don't have to follow if you're going to use it as a strategy. And I'll highlight that as we go through this.
Okay, good deal.
All right? All right. So with that, let me jump into this. So this is the Market Gear platform. Really, I want to stay focused on the content today, but just to let you know, this is you come in, this is the main page you're on. I'm going to go over here to my research page, and I'm going to look at a couple of stocks here. And the first one I want to look at here is I want to look at CRM. And one of the cool things that we let me just switch accounts real quick to this one because that's where I have it. Here we go. One of the cool things we do on this, first of all, in the platform, you can connect to multiple brokers and you can actually aggregate together all that. You have multiple accounts at the same broker and flip between them real easy. One of the things we do is we show you, if you have a position on, we show you what that position is right on the chart. So in this particular example here, I have CRM, Salesforce, and I bought the stock. I mean, let's talk about picking the tops, man. I did a pretty good job there, didn't I?
That's pretty good.
Just that it seems like I can be good at picking the tops and bottoms, but I always do the opposite of what we think is going to happen. Anyway, my staff said, good news, bad news, you're not always right. Good news is you've got a lot of repair strategies up your sleeve. So, there we go. So in this case here, I have the stock and I bought it. My cost basis is $189.65, and right now we're sitting down here at $159, right? So so what I'm going to do is I'm going to go over to our options page, and when I do this, there's some kind of cool things on here. I'm going to go bring up a couple of expiration cycles. I'm going to bring up the October. I'm going to stay with the standards for now. Weeklies work too, but just going to stay with that. One thing, by the way, that we do here is kind of cool is we show you when you come into the options, as you get ready to pick your expiration cycles, you can see whether liquidity is good, whether the options are skewing bullish or bearish, and so on. So it's kind of cool. Awesome. But then I'm going to bring up the actual chain here. So here's my here's the options chain. Over here on this side, if I have a position on, it's always going to show you what the position is. So I have an existing position on. It's the stock. I currently own 100 shares of it. And the current value of the stock's at 159, even though I bought it at 189. So I'm literally down $30 or 15% in my position.
Okay.
Right. So here's my risk graph. This line, actually, you know what? I'm going to do something here for everybody because we have different themes on this. And if the contrast for the webinars is just a little bit better here. if I use my lighter theme. So I'm just going to, so we're in the exact same thing we were just in, just switched over to my lighter theme. So this is where the stock is today, this line right here. And this is my, a stock risk graph is just a 45-degree line, right? Just, every dollar the stock goes up, I make $1. The stock goes down, I lose $1. Yep. But we're going to use that here. So I want to show this to you. And this is where we're at, obviously currently underwater, right? So what I'm going to do here is look at how we can adjust this. Now to do this, I'm going to take a snapshot of this trade. There's little cameras up here. I'm going to take a snapshot of this because I want to compare my adjustment to my current position.
Okay.
Right? And so then I'm going to come over here and let's see, do my adjustment. So what I had said was that we want to sell a covered call.
Okay.
Right. So what I'm going to do is I'm going to sell this covered call. And I'm gonna go out to 90 days. I'll give you some better rules, but I want it to work right out the gate in a second here. So I'm going to do this. And what we're going to do here is when I sell, and this is an important rule that I want to highlight here. Let me just go to this really quick. The strike that you sell should be no lower than halfway between your cost basis and the current price. Okay, no lower. So if my cost basis is, let's just, make it easy math here. My cost basis is 190. The current price of the stock is 160. That's $30.
Sure.
Half of that's 15, right? So I can't go any lower than $15 down from my 190 cost basis, which would put me at 175, right?
Okay. You can't sell the call lower than that strike.
Right. And because if I do, I won't be able to fully recover.
I got you.
Right. So that's an important thing. So wherever you bought it, from where you bought it to where it is today, halfway in the middle is the lowest strike you want to go. That would be 175. So right here is 175. If you look at this, the 175, we're getting $7.45. Now I currently own 100 shares of stock, so I'm going to sell one contract. Now, just to bring up this here, if when I do this, you see here that I'm selling the one contract. That money is in my pocket if I do that, right? So that $745 is now my cash, period, right? So you're already, you're not, you could still lose money in the trade the way this is set right now if I just did the covered call, but bottom line is I still put the money in my pocket and that's now mine, whatever happens to stock happens, right? If it goes above 175, somebody's going to buy it from me. Right? So that is the covered call. So if we look at, my stock position right now, here we have the covered call. This difference, why my profit, first of all, for those of you not familiar with this type of risk graph, this is stock price versus profit or loss, right? So green zone profit.
And we got a little red for probably a negative number and a little green for a positive number.
Right, exactly. So right here, this is the stock position. If I do this, I didn't lose. If all I do is a covered call, I will not have lost as much. Why? Because I put $745 in my pocket when I did this trade. Right. So I'm going to take that 745 and now I'm going to see if I can go out and buy a bull call spread.
Okay.
So let's take a look at what's a bull call spread. A bull call spread. We're gonna buy at the money, and we're gonna sell the same strike we already sold. Right.
Oh, okay. I'm gonna double up on that.
I'm gonna double up on the 175. Right. But I wanted to stair step into it. So right now it's just a covered call, selling one call against the stock I already own.
Okay.
So now what I'm gonna do is I'm gonna go in here and by the way, I have $7.45 to do this. Let's see something here. If I were to go buy just one for a minute, right? And the reason I'm just doing that is just for easy math. It is $6.70. Right. So buying one, selling one, right? My bull call, if I were to just do a bull call spread, my bull call spread is going to cost me $6.70 or $670 to do the bull call spread. And when I sold the call, which I'm now going to, let me sell that call here. I sold the covered call. I brought in 745. So the 745 I brought in allowed me to buy the $6.70 trade, and it actually ended up, if I do this adjustment, it will put $75 in my pocket when I do that. And again, that's my money no matter what happens at this trade at this point in time. Now let's take a look at this risk graph, and this is where it gets really fascinating. From where I'm at today, now mind you, I said that you really want to be bullish from this point up, right? Where you think it can go up from here. So if you look at this, notice what happens. I'm in the red one, I'm underwater by, the $30 a share. And to get back up to break even, it would have to go all the way up to 190, right? In my blue line, what happens here, look at this. I'm making money now. I'll talk about in time. Right now, I'm talking expiration numbers, right? We'll talk about managing. But in this particular case, for every dollar the stock goes up, I make $1 back in my stock, right? Because up to the strike price I sold it, right? So right now, from that 160, stock goes to 165. I've made $5, right?
Yep.
However, because I also did the bull call spread, I'm also making $5 on my bull call spread, right? So I made $5 back on the stock. I made $5 on the bull call spread. How much did the bull call spread cost me?
That was
nothing, right?
Yeah, that's right. You got the $75 in your pocket.
I have $75 in my pocket. So bull call spread cost me nothing because I used the money from the covered call to do that. So now I make $5 on the stock. I make $5 on the bull call spread. Boom. Right. So as this continues to go up, what happens is I'm making $2 for every dollar the stock goes up. Again, expiration numbers, but $2 for every dollar the stock goes up. And if the stock gets to right here, right now, this is 174. Let's just call it 175 because 175 is that a little higher, but 174 and change, I'm back to break even.
Yep. As opposed to the 189 from the beginning of this trade with nothing on.
Right. Yeah. So I got 189.65, right? Again, we'll just call it 190 for numbers here. Yep. Right. So I got 190. And so I'd have to hold the stock till it got all the way back up to 190. Or if I do this trade, I now am break even at 175.
Right.
I started out with a big flame. I said that you'll be able to make your money back in half the move. It's exactly what happened. From 160 to 175, $15 move. I'm already break even. And if I would have just held the stock, I'd still be $15 underwater, and I'd have to have it go to 190 to break even. Right now, the one thing about this is you are capping off at that level, right? That's your max gain. Is that basically getting to break even. But so what? I'm upside down. If I'm able to get to, I don't know how you operate, but I consider a break-even trade a winning trade. Especially if it went wrong.
Yes.
Right. So I'm able to get to my break-even quicker. Don't have to have as much movement in the stock to do that. And again, I literally have to see the stock go up to, a little bit above 190, 191 to be at the same place I am by doing this stock repair strategy.
All right, let me jump in and ask a question. So what, and you may come to this too, I apologize for jumping ahead.
No, that's good.
What do you do when you get to break even or beyond? Okay, and beyond doesn't mean much now that you have this new trade because it doesn't give you any more value, right? Do you get out of all the legs and start over? What is the strategy once you get back to break even, which we're all happy about, right? We've had a big loss here and we're like, God, that sucks. How about now we're break even? We did this great stock repair strategy and we're there. We did it. Now what?
Okay. So in this case, the answer is you unwrap the whole trade, which is basically I own the stock, so I'd be selling it. I own the 160 option, so I'm going to sell it. And then I'm going to have to buy back the two 175 options. Okay. Now, I will tell you that if you do this stock repair and the stock goes up tomorrow, it just bounces up $30, you're going to have a little bit of a hard time getting out early on the trade. But as you get to halfway, and I'm going to talk about length of time in the trade in a minute, and how to kind of work that. But you want to basically do the stock repair strategy with the least amount of time necessary to make it work. And then that way, you've got, less time that you're locked up in this where, and if you want to unwrap it, it's easier to do.
Do you find a honey zone, Rance? Do you find like there's the 30-day expiration, the 60, the 90? Is there a honey zone that you've
there tends to be 45 to 60 is kind of the honey zone. right?
Yeah.
That's the ideal. Now, and by the way, one of the things about this is, and I was looking this at on Procter and Gamble, and I was looking at it on Amazon, both of these as I was prepping for this, and Procter and Gamble just doesn't have a lot of volatility, so the premiums aren't that great.
Okay.
So in order to get the premium, I got to go further out in time.
Sure.
Right. Where if it's something like Amazon or, even here on CRM, I don't have to go as far out. So there's two factors here you look at. You got to get it on for break even or better. Right. And in this case, we put $75 in our pocket to make that happen. And then the other one is that you want to make sure that you do it in as short of a time frame as possible. So what's going to happen is there's going to be times where it just doesn't. I mean, you can't repair every one of them, right? So there's going to be times where the math just doesn't work because you're out 6 months in the trade to make it work, right? And to get the premiums to make the math work. And I don't think that's a great idea. I think you ought to keep it on, if you can keep it at I would say my threshold is probably, not probably, my threshold is 4 months. I don't want to go more than 120. That's my number. That's this because, I mean, and in today's market, things change quickly. So, you want to keep as short of a leash on that as possible.
Got it.
But just to show you, because it's a real important thing, this discussion of time is actually a really important piece to this. Yep. So if I look at this and you can go do all the math, but I'll show you the super simple way to do this. The only thing you got to know is what's the halfway point? Well, what's the halfway point? $30 loss. Yep. Take your number minus half of that number. That's your strike, right? So I got one, again, rounding numbers, 190, $30 loss, 15. That means 175. Okay. I'm going to go to the 175 and I'm going to sell that one twice. And then I'm going to buy the at the money, which is at 160, buy that once. And here's your risk graph. Now, let me just blow this up for a second. What you'll notice here is I'm a little bit below the break-even line.
Got it.
Right? The reason I'm a little bit below the break-even line here is that if I were to do this trade, it's going to cost me $160. I said we want to be in here for net zero or a credit. And that's going to cost me. That 160, that's that mark right there below that. Now, the one thing I will tell you is that, if you decide you want to go do the trade and so it fills out here, the trade ticket here, and I want to try to work that bid-ask spread, I might be able to get it closer to break even. In this case, no, it won't. It won't get there. So I look at this and go, okay, well, the Novembers don't work. So then I go out the next month, December's, and that's 93 days, right? So it's still under my 120. That's like kind of that 3 month like. That's right. So it's still okay. I'd love for this to work, but it just, the math doesn't work, right? So what I do is, by the way, this is kind of cool too. You see this position here. I just go, these icons, watch this. I just go, boom, click that. And guess what it just did? It moved the whole trade out to December.
Okay.
Right?
You can move it on expirations.
You can move it up and down, right? If you look at this here, I can move it up and down. I can move it out in time or back in time. I can widen it, narrow it. And the cool thing about that is it allows you to really look at your position here and kind of optimize it, right? It's just a nice, quick way to take, I've established a trade. I just want to move it up and down or back and forth in time and all that stuff. And it kind of works out really well.
Yeah, that's great. And can you move an individual, one of the legs of?
Well, I can to move an individual leg. I would just and by the way, you can type in the quantities too. I just find that clicking on bid now is a lot easier, right?
Yeah.
So if I just do that, now I'm in that one there, right? I can also do that by narrowing the spread or widening the spread, so I can move one leg that way, right? So that's kind of cool. So it's kind of a cool way. I just one of the little features on here that's a nice way to be able to see how that works out. And that. So if let me go push it out to the next month because that was the math that worked. Yeah. I'm in this for that $75 credit, and that's without getting between the bid-ask spread. So if I go in here and let's say I work that a little bit, I might get instead of $75, maybe 87, 85, $87. Let's go 85. And if I like that trade, all I have to do is go place that. What this will do, by the way, if you notice something, it's a smart ticket. It knows what needs to happen, does that, and then I can go ahead and place that trade and now be able to have that one on there, right? So, so now if I go over here, I want to show one more of this. I'm going to go to Microsoft on this one, and let's see, we'll go back out to November. So this is one too, just so you can see where I'm at on this one.
Yep.
I wasn't quite as good at picking the top, but we're still underwater. And you look at this. I mean, this nice level of support from Microsoft, right?
Yeah.
And so we're like, okay, I'm feeling like this could be a good position here. So I go over to this. I've got I've got my October's and my November's open. Let's see if the October works. And again, I'm going to do my quick math here. Okay. I got 2680. I'm down 2684. I tend to round it to the, so I'm going to go back up to 30 because the strikes aren't going to be between that anyway. So I got to come down $15 from my my cost basis of 278, which would put me at about 165, right about that. So what I'm going to do here is let's just go try this. I'm going to go sell that twice, buy this once.
Right. Yeah. Okay.
Yep.
Okay.
And you'll notice that this is going to cost me $260. That's a negative number. I'm going to put more money in the trade. It's not bad if I can get, all but $260 back to break even when I'm down, to 2,600 right now on this. It's not bad, but it's not what I want. Right. Sure. So what we're going to do is, instead of the rollout, I'm just going to establish it down here. Where I'm going to go sell the 2 and buy the 1. And let's look at this here. Right. Again, I can go mess with all the math and figure it out, or I can just click some buttons and say I got a $55 credit on this. Okay. Right there it is. And again, if I blow this up to say this, if I, I didn't do it. Let me just do this. I wanted to do the snap because I think it's really important to know what you're comparing on, because you don't want to put something that's going to be worse off, right? Anytime, one of the cool things about this is you can do all sorts, any position you have on, you can do all sorts of adjustments and rollouts and all that stuff to it. And you take and compare your current position to the to what you're going to end up in, and you just got to make sure you're in a better position, right? Sure. And I've seen this when I was director of options trading. I saw so many clients go in and it's the tail wagging the dogs. They're chasing this thing and they're in a situation there's no way to win. Right. And this one here, hey, all I have to do is have the stock move up that $15 and I've made back the $30 that that I'm down. Now I'm only down 26. Well, in this case, I'd end up in a profit. I'd end up making $270 in this trade if it went up to anywhere above my 165 strike. So it's a pretty cool little setup on that.
Yeah, I love
it. That can allow me to do it. And so one of the things I want to just be really clear on the rules here is, again, the strike I sell needs to be no lower than halfway between the cost basis and the current stock price. And we want to make sure that we're break even or better, or a credit would be great, right? If I can get a credit, that's awesome. But if I can do it for net nothing, I'll take that. If you need more premium to make it work, as we just saw, consider more time, right? So if it wasn't working out for me in the 37 days to expiration up here with the Octobers, so I just went out to the 65. That's still in my sweet spot,
sure,
right? And I like that, and I'm bringing in some credit in the process. I'll take that trade, and it's a great way to to be able to adjust that trade. Now, one of the things that you had asked me, and I mentioned that I usually kind of save this to toward the end. I say that, well, do I have to wait till it's broken to do this, this strategy? And the answer is absolutely not. And, if I were to take something here, let me just go to Amazon for a moment and we'll grab, I'm just going to grab the 1 month on that one, the 37 days. And let's just go in and buy the stock, 100 shares of the stock, buy the, at the money option, and now I just need to bring in enough to I need to bring in enough to pay for that. Well, as I say that, I can only do it on a $5 spread, so I don't think I'd want to do that. Okay, it's too tight. So I'm gonna go out one more. Let's go out one more. Let's go to the standard options. That and then clear this, and let's try this down here. Again, go to my at the money position. I still want the stock. And buying that. So now I need half of this. So I need $4 and change. Well, look at this, man. I can go up pretty far here. Yeah. To make that, to be able to make that work. Right. So the so let's see if I do this. There we go. Got a nice. But in this case, I don't have to worry about what the strike is. Right.
Okay.
I don't have to worry about. I just look at it and say, hey, can this one I sold pay for 2 of what I'm buying? And as long as that works, I'm good. Right. Maybe does it work here? See, now I'm in a debit, $128 debit.
Yeah.
You just move to where the numbers are going to work for you, and then you're good and you're ready to place them. So the thing about this is that again, you're buying. Generally speaking, if I'm doing a bull call spread by itself, not as part of this, where I position it might be a little bit different. But in this particular case, I tend to buy pretty close to at the money, which goes against some of my rules on what I like to do when I'm buying. But it does give you, kind of that 2-for-1 gain up to whatever that strike is. And we happens so much. The fact that we show the risk graph all the time.
Yep.
I have an immediate visual of whether or not I'm doing the right thing. And I'm like, well, what's that not right about? Oh, I didn't have the stock in there because I cleared that out.
That, by the way.
Well, right. And that visual will keep you. I'll tell you, I can't tell you how many times we had people do, they thought they were doing a bull put spread, but they did a bear put spread. Right. And then they realized they were in the wrong thing. And they call us back and asked that, can you get me out of that? Well, can you cancel that? Not exactly the way it works. So
exactly.
Right. But this is a strategy. It's a stock repair strategy. That's how I learned it, as a repair.
Sure.
And the great thing about it is half the move, you get to be made whole in the position. And, you just have a couple rules there that we talked about to make sure that plays out.
Right.
That is the never buying below halfway. But again, and doing it for a credit or break even or credit. I would still live by the break even or credit rule if I'm just going to do it as a strategy, not as a fix.
Okay.
But this first rule doesn't apply if you're doing it as an entry trade, right? It doesn't matter. And so it gives you the ability to really kind of have even more flexibility on how you do that. But it's a great strategy. It saved me. I can't tell you how many times over the years. And you have something that now again got to be bullish from here. That's why I'm looking at Microsoft. It's like, hey, this is a pretty strong level of support going on, and I feel like there's a pretty good level of support going on in here, and a pretty good chance to move up from here. So that's what we're looking at on this particular one. So you want to make sure you've got that bullish outlook from this point. But if it doesn't go up, if it doesn't go down or up, it just stays there, you're no worse off.
Yep.
Right. Maybe even put a couple dollars in your pocket and, have the ability to kind of work through that. So anyway, that's the, but once you're in a trade, it's just inventory.
Sure.
Right. It's like, what do I want to be in? What do I not want to be? Right. So if I'm in a bull call spread, for example, and the stock starts to go down, I could actually take that trade and flip it to a bear call spread and make money on the change in direction now, right?
Sure.
Let's say I'm in a bull call spread, the stock's going up. I could take my trade, basically sell it and do it again on top of that, but do it as one move, right? So basically you're overlaying an inverted butterfly, right? So the thing I kind of go off on this whole thing about, well, what do you have and what do you want to do? Right. So where do you want to be? So whatever I have today is just inventory. I don't have to stay in a stock. I don't have to stay in a bull call spread. I don't have to stay in my bull put. So I can flip this around to different things. And one of the cool things I like about this is that in here, I can see what my positions are. And then I can go and, play with whatever I want to play with and do all this stuff and end up getting, whatever other position that might be a good one for me. And so it's really a powerful piece here to be able to look at it as don't get locked in. I did a bull call spread. I have to live and die by a bull call spread.
Yeah.
Right. It's just, what could I do to make it work? And again, one of the things I love about the fact I can do the snapshot and then make the adjustment. I can see visually, am I better off based on my new outlook of the stock, am I better off with this adjustment or not? And if I'm not, don't do it. Don't chase it, or come up with a different adjustment that may make it work better. But that's the thing about it. So that particular thing, I'm gonna play with that because I think that's an awesome approach. But
I'm going to throw another curveball at you. You ready for this?
Yeah,
not a curveball. I'm just thinking this as we go. If you have a loss in that underlying stock and you change it, you made a synthetic put out of a short put, and you sell the stock and you sell the put, you're taking a tax loss.
You are, right? Yes, yes.
So now I'm thinking to myself, okay, I'm going to save on the tax loss there.
Yep. So you get the you basically ended up in the same position.
Yeah.
While being able to take the loss today.
All right.
And if I get made whole, great. If I don't, or even if I'm made whole, I still have this loss to counteract that gain, right? So it's right. And if that's an interesting approach. I do have to just share one thing though. I have seen on a number of occasions where people were profitable in trades.
Yep.
And held on to it until the next calendar year.
Oh boy.
And we're no longer profitable.
Yeah, right.
Right. So you want to be careful. Which, by the way, the other thing about this strategy is I didn't have to wait until next year. Right. Yeah. I do it today. Bam. It's had the tax impact. I get the benefit from that loss, and I can still make money on the trade. Get back to break even in the trade as well. So when you start playing with this a little bit, it's great to have some of these things under your in your arsenal that you can do. And it's kind of cool because I've also seen people box trades where you have a profitable, you can lock in a profit by doing a synthetic short to get through a window of time. Like let's say an earnings report where it's something that, you got some bad news on the horizon, like what's going to happen with COVID, when that happens, somebody wanted to protect. Now, obviously it blocks your gains as well, but it just puts you neutral for a window of time, right? By doing a synthetic short against your long position.
Yeah, I love it. I love the strategy. This is awesome.
This is kind of a neat way. And I'll tell you the thing about this, people that aren't, I realize that this is a 3-move thing, right? So it's a little bit to it, but it doesn't take an advanced options trader to be able to do this.
No, I totally agree with you. I love this. This is something that even the intermediate beginner person can sink teeth into and get with it. So
right. Yep.
Yeah. Yep. Very clever. I love it. And by the way, I love the platform too. So real quick, we got to close. Tell me, can people sign up for the IvestPlus and what's the deal there? I know we did the market
marketgear.com, right? So IvestPlus is really B2B, but marketgear.com is is our primary retail platform site, and that's what we have up here right now. And you can start a free trial on this, get a chance to kick tires on it. The one thing about this, we've talked about a very narrow thing today. There's a lot of stuff in the platform. This one feature I want to mention to you, because bar none, we are absolutely an industry leader in this, especially if you're an options trader, is our journaling functionality. Nice. The journaling capabilities within this platform are just incredible. It gives you a ton of insight on what's working for you, what's not working for you. You can track things by any tagging method you want, all this stuff. And what I will tell you, out of everything about all the platforms I've ever been involved with, the one thing that helps people be able to improve their trading more than anything else is insight into the results that they've been getting. And unfortunately, most people don't journal, or they're trying to do it in a spreadsheet or this thing auto journals for you and gives you a ton of feedback on what's working and what's not working. We also we hook up to your virtual accounts, right? So they can trade in a virtual account and still get the benefits of journaling, and all that stuff. So there's some really great power in that. We were looking at the options thing, but we actually have option templates for the 20 most common. So, instead of looking at the whole option chain, if I want to do a bull call spread, I could just look at the bull call spread, right? It keeps it really nice and clean, easier to understand options. It's a great way for people to get introduced to options because of the visuals, because of how this is set up, all the calculations done for you and so on. And then we have extensive research, including our scanners, which actually have in it trade finder scan. So everything in here, these are trade finder scan. Like this is a bull put trade, and these are actual, it's telling you the expiration date, the long, the short, what you should be getting for all that stuff. So we have these trade finder things to help you get down to the quicker hits on some of the opportunities out there. So there's a lot to the platform. We also do offer free monthly trainings on it, and the reality is that there's a lot to this, and so we have an extensive help center that also is in the platform with a whole bunch of videos and tutorials and so on too. So really recommend if they get a chance to check out marketgear.com and do a free trial on it, get a chance to check it out.
Perfect. Can one more question about it? Can you tell us about, is it a monthly subscription cost?
Yeah, it's a monthly subscription.
Okay.
And here's my viewpoint about that. You go to a broker system and it's free versus why would you pay a subscription? It better bring the value in to make it worth that. So if I can help you find trades faster, if I can help you adjust and fix trades, if I can do that and give you insight in the journaling. There's nobody in options trading that touches what we do in our journal on the whole. It's a complex piece, and so the monthly is $75 right now. We've got a third off of that for the foreseeable, so they get a break on it. And again, if it's not generating more than it costs, then you shouldn't keep it. And what we found is that it will in short order. The one thing I would say is when you do it, you ought to come through one of our live trainings because you get so much insight on how to use it to improve your trading versus just the out of the box, experience.
No, I love it. I love it. And then I'm going to give a trade year plug real quick. If you're into that trade year, we have a special pricing model as well, whereas you pay that fee and there's a no commission per option contract, which is really a great deal.
I'm going to tell you, I have not seen that at that level. That's like one of the most aggressive pricing things I've seen. It's a small monthly fee on it. And the thing about this is, when you're doing spreads, you're doing lots of legs, right? And the fact that you can do all this stuff for literally no contract fee, right? There's not a ticket fee anymore, but there's contract fees, and traders been able to eliminate that. And the thing I just got to again mention, I said it in the beginning, but I think it's really worth bringing it up today. Especially when you're doing multi-leg options, the fill that you get for your position is critical. Yeah. And it can be the difference between a small profit and a large profit. In some cases, a loss versus a little bit of a profit, right? So the fill, you guys do a great job. I don't know how you're working those relationships, whatever, but Trader does a great job at the fills. And that and the fact that for a very low monthly thing, I don't even have a contract fee. That's awesome. And so it's been a great relationship. I am so glad that we got this going with you guys, and it's been a great thing. Just back and forth. They work really well together.
Good. Awesome. Listen, we're going to close it, but Rance, you've been terrific. I think everyone's going to get just a great bit of information here. Please go to marketgear.com, everyone. Sign up for this. I love it. I've been in the options business so long. I haven't seen anything like this. This is fantastic. You guys did a fantastic job. Will you come back? Let's do a follow-up show.
Sure. Be glad to.
We'll do another strategy or something.
Yeah, we'd love to do another strategy. And we got a couple of cool ones out there that we'd love to share with your viewers. Absolutely.
Awesome. All right. Well, thanks for coming on. Stick around for a little bit after this and we'll chat up. Okay.
All right.